Hi everyone. So today in this lecture we are going to start with the most important area from the exams after the forex chapter. So the top hit list areas like portfolio theories and next followed by the forex and next one will be the derivatives. So as a chapter, derivatives will be having four divisions. First one is called as a derivative options. Second one is derivative futures. Third one is currency options, currency futures and other forex related. And the last one will be discussing about the area called as interest rate risk management and swaps. Four divisions are there totally and we are also going to discuss in four different parts. So the first one, derivative futures and options or options and futures anything. When it comes to the level of understanding and complication involved, options will be to some extent complicated than futures. So why options is complicated than futures means I have some reasons behind that. First we are going to start with derivative options for that same reason. Why options are seemingly to some extent, I am not telling totally, to some extent, relatively, comparatively it is more complicated than futures concept because of 2-3 reasons. Reason number one, not understanding the parties to the options market properly. What does it mean? When I tell a share market, there are only two parties. One is a buyer, another one is a seller. When I tell futures, there are only two parties. One is a buyer, another one is a seller. Buyer buys the share, seller sells the share. That's all over. But in options market, there are four parties involved. One party will do two things. Another party will do another two things. From the level of activity, we have four different kinds of persons in kind of options. Why? Option writer, option holder, share buyer, share seller. Four concepts will be there. In share market, that means in the cash market, we find only one person, buyer, another person, seller, two parties. But in the options market, no, there will be four positions. Maybe two persons only will take it, but positions are four. Four positions will be there, which creates an option contract. That makes the concept more complicated to understand than the general concept of shares and the general concept of futures. So how the options are differed from normal futures and share market transactions is the first part of our discussion. This lecture which I am going to discuss now will in depth cover inch and inch behind the concept of options with classic examples, understanding the idea behind. If you are one looking for the correct understanding of the options as how it works, let's start with this particular lecture. Listen to this lecture completely till the end. It gives you immense conceptual clarity. What you are losing in the previous parts before the class, whatever you are lacking in understanding the concept of options, I give a guarantee that definitely you will be having times, minimum 10-15 times a better clarity you will get by the time we complete this lecture on introduction to the options. Introduction to the options will be very in-depth such that the parties inside the options contract, the ideology, the mechanism, the architecture of options, everything we will try to understand clearly, including the parties and what is their work. Am I clear, everyone? So therefore, how the options concept started in India, how the futures concept started in India, the logic behind options and futures, ideology, the mechanism, architecture, as I said already, everything we are going to discuss in detail in this particular lecture. Before even going into the chapter, first let us know the learning objectives of this particular chapter called as options. Okay, let us see the learning objectives on the screen. See there. What are all the learning objectives? Meaning of derivatives, meaning of options, concept of options, parties inside the options, net payoff under the options, break-even point and related issues, theoretical boundaries on call option and put option, arbitrage in options, put call parity theory with arbitrage, option valuation models, binomial model, risk neutralization model, binomial tree model, Black-Scholes model. So these are all the various concepts that we have to cover. Once this is having a clarity na full derivatives like any question can come in examination, you will be in a position to answer. But even before going into this, if you see the learning objectives clearly, I simplified the entire concept of derivatives into these learning objectives. Okay, so 10 learning objectives will be there totally. How many? 10. So these 10 learning objectives will cover entire concept of options. I am not talking about just one or two. Entire. When I tell entire, it covers from the very logical beginning till its very logical end. Each and every point inside the derivatives will be impeccably covered from the beginning till the end. Am I clear? So this concept of a meticulous derivatives area is one of the most sought after area if you want to become a stock investor in the near future. So if you want to really invest in the options, if you want to really invest in the futures, this is a high time to understand these basics clearly before you start making your investments or before you start writing the exams. Clear? So in-depth coverage we are going to make. So let me first put out how the notes has come with regard to the basic concepts. I have first make an introduction on concept of derivatives, later understanding of options market, later concept of options and parties, put option and the parties, parties involved in their activities and notes on that, and lastly the models. So the payoff and terminology, exercise and labs, when to do, when not to do with explanation, everything I have done, and put option also like that, when to labs, when not to labs. So after that, quite a good number of 3 problems to understand the basics. So 5 problems I have done totally up to here. So our first lecture will concentrate up to question number 5 in our material. So those covers all kinds of basics inside the concept of derivatives. Okay. With this introduction, let us start our lecture on derivative options. So derivative options is a concept of one of the area inside the derivatives. What is derivatives and all those we will understand. First, I am giving you only a 1 minute time. Please copy down the learning objectives. If time is not sufficient, pause the lecture and write down. Start now. So hope everyone has completed writing the notes. Now, let us now progress into the next area of derivatives concepts. So generally people think that derivatives takes the shape from the stocks. To be very clear, it will be from the shares. But in India, derivatives concept didn't start with the shares. The concept of derivatives was initially started way back, okay, in the Greece in the year 1692. The first derivative transaction started in this world. Derivative transaction means what? Derivation or a derivative is a concept derived from the ancient mathematics. Okay, so the ancient mathematical calculus will use the word derivation. Derivation means always a derivative is calculated in mathematics. In early mathematics, what we do in 10 plus 1 or 10 plus 2 or even in 10, the concept called as a dy by dx we will do. What does it mean? It means change in y to the change in x. If x changes, definitely y will change, but how much influence is passed on? That means x changes, y will change. Y will change to the same extent or to a lesser extent or to the more extent. that itself is called as a derivation. So derivation is a concept of change in one variable with the change in the first variable. So the x is called as a first variable, y is called as a secondary variables. So change in y to the change in x itself we call as a concept of derivative. So the same logic applied also on the shares. Change in the derivative option value with the change in the share price means if the share price doesn't change, options and futures values don't change. That means the change in the derivative value and the change in the futures and options value depends on the change in the value of the share underlying it. So therefore try to understand, that's why these are called as a derivatives. It changes not by itself, it changes because of another variable. Variable is something which can vary. Simple language. Variable is something which can vary. Anything which can vary, we call as a variable. Anything which do not vary across any situation, we call it as a k in mathematics, also called as a constant thing. Okay, it's a fixed one. So derivatives, options and futures both are called as derivatives because they don't have any original possession of a value. Their value depends on the value of the underlying asset. The underlying asset we call as a share. So the share value changes, derivative value changes. That's all. Hope everyone understood the point clearly. How good the derivative that is underwritten, that good will be the value of the derivative. Clear everyone in the class? So derivative is something which derives its value from the value of its underlying asset. Is a derivative. It's a paper now. It's just a piece of instrument which gives you a right on the underlying asset. That paper is called as a derivative. Understood the point up to here, right? Now listen carefully to the point. History of derivatives in India. I am not taking of each and every event and moment that happened in India. I just want to tell 4 important events. Number 1, 1875. Setting up of the India's first derivatives market, but only commodities are getting traded at the time in the form of cotton, silk, indigo and opium. Opium is banned now, at that time I am talking about. 1875 first setup of India's derivative market. What is derivative? Derivative is nothing but we will lock a price today itself for a transaction to happen at a future date. British officials used to trade in cotton, opium, indigo and other spices on derivative segment in India. That means they will lock a price today itself which they will buy in the near future. So that's called as a commodity derivatives. But the surprising point is in India, the first derivatives market is not stock derivatives, it's commodity derivatives only. Because cotton, silk, indigo, opium and other spices are the materials which are traded on derivatives in India at that time. So India first derivative started not on stock derivatives, but it was started on a commodity derivatives. Okay. 1935. British government has passed a law in India saying that some products or commodities covered in the first stage are banned through derivatives. So if they are cheating the Indian public, therefore they passed a law saying that no derivatives on certain commodities. So ban on certain commodities made by a law passed on that. 1952, India became independent as well as a republic. Okay. So therefore they passed a law called as FMA 1952 is passed to regulate them. What is FMA 1952? Established Forward Market Regulation Act. Forward Market Regulation Act. All kinds of forward contracts means you will enter into contract to today for a transaction to happen at a future date. Those are all called as forward market activities. Okay, for that a authority has been formed with the name called as a Forward Market Commission. Okay, FMC means Forward Market Commission. Established a Forward Market Commission with an act called as a Forward Market Regulation Act, which will regulate the futures and options in India. Not only that, also any kind of forward market will be covered in under that act. It is a division of SEBI and it is also overseen by another ministry in India called as Ministry of Finance. July 2nd, 2001, trade in index futures and options started in India. From then we didn't turn back. India has become one of the biggest leader in derivative segment in the entire world. I'm not telling one rank number one, but stands at the first 5 ranks in the entire world in the derivative segment. Means that's because of the index futures and options that happened way back in the year 2001. So like this, I can give 12 to 13 events happening, but I just don't want to waste time in discussing about these unrelated issues here and waste our time. So mainly you need to understand derivatives is not new in India. It is there since 1875, but originally they started on commodities. Later they added the stocks and shares in India. Okay, if anyone want to copy, just I am giving you 1 minute time. Copy down this quickly. Completed writing the notes. Next one. Okay. From here, let us start with the introduction to the concept. So see here, introduction to the concept of derivative. As I already said now, in general meaning, derivative is an instrument which derives its value from the value of its underlying asset called as a share. Commodity is also understanding sake I have written share. Okay, this means it is a tradable stock like a share which derives its movement from the share. Two types of derivatives are there. One is options, another one is a futures. Derivatives and options, derivative options and derivative futures are separately traded on NSE and BSE in a separate segment called as F&O segment. F&O means futures and options. Next, derivatives are used for 3 purposes, namely speculation, arbitration and hedging. Speculation, arbitration and hedging. Sir, what is this speculation, arbitration and hedging? Okay, listen carefully. What do we mean by speculation? Speculation means I will buy, I will sell. I may get a profit, I may get a loss. Anything may happen. Buying and selling they can do. Speculation. Arbitration. 100% I will make only gain. Market like imperfection is there. Knowing about that imperfection, I will jump into the market and make a sure gain. That's called as arbitration. We will see how really it will work when we progress into the chapter called as options. And next, last one is hedging. Very, very important, very, very popular. Options, like this is popular, hedging. Options and futures both. Hedging is very, 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 very popular. Exam questions also asked only on hedging strategy. Okay? Listen carefully. What is this hedging? Speculation means I make a gain, I may make a loss. Arbitration, sure gain. Hedging means I will not make profit, but I will reduce the loss. So hedging is also called as a stop loss strategy. Hedging is also called as stop loss strategy. How it happens, let us try to understand clearly. See here. I want to buy a share in future. I want to buy a share in future. Okay. If I have to buy a share in future, you may ask a question. Sir, why derivative options, sir? When already there is a share market, why again F&O segment? What is the purpose? Two purposes. Now we are discussing the chapter called as derivative options. Therefore, I will restrict my discussion only to the options. Futures and everything we will discuss when we come to derivative futures at the next stage of the discussion part. As of now, restricting my discussion absolutely and exclusively only to options. Sir, why derivative options? I have already a chance to buy in the market, sir. Why options again? Listen, there is a difficulty. There is what's a difficulty. Future is always turbulent. Okay. What is the value of a share? A value of a share is present value of future cash flows discounted at a required rate of return. Means the value today is dependent on a future rate. Yes or no? Now that future is always a turbulent. Means it can move up, it can move down. Anything can happen. Only my expectations I will make. But in reality, God should know what will happen on the date. Therefore, I want to purchase a share. I want to purchase what's a share. When today now, in future after 3 months. Today itself I want to lock a price. Today itself I want to lock a price. Okay. That means if the price goes to 90 on the day, for example, I locked myself at 100. If the price moves to 120 or 130 on the day, still I will be able to buy only at, okay, still I will be liable still I will be having a chance to buy at rupees 100. If the price falls below 100, like 90 or 75, 80, 85, etc., I will be forced to buy only at 100. Generally, that is called as a locking price, also called as a head, also called as a forward. Dollar forward, how will it will happen? You will go to the bank and you will lock $1 equal to 80 rupees. Means what? Dollar may rise beyond 80, dollar may fall below 80, but you have to buy and sell only at 80. That itself is a concept of a forward rate with the bankers in case of foreign exchange. Same concept in the stock market we call as an options contract, but here the beauty of options is that buying and selling is an option to one of the party. I will explain this way. You go to a bank, ask for $1 to be purchased in the forward. Means you said I want to buy $1 lakh, not today, but in the coming future. Say for example, after 3 months I want to buy. Because I have an import payment due on the day, I will take dollars from you, you said. Banker said, okay sir, sign on this agreement. You signed on all the agreements, everything over. Okay, this is the scenario. On the day, dollar rate has went to 85. Still you will pay only 80. Dollar rate has gone to 75. Still you have to pay 80. Means what? Banker has an obligation to sell dollar. Customer has an obligation to buy the dollar. So there is an obligation set on both the parties in case of forward contract. Okay. So cancellation is there. For the cancellation charges, swap loss, all these things are also there. Na? Freely you can't cancel just like that. Okay, you have to enter into a counter agreement. For buying cancellation, you can't just cancel it. You have to enter into a counter sell and make the balance payment, interest on outlay of funds, interest on inflow of funds. All the headaches will come. Directly can you cancel? You cannot. So therefore, in case of a currency forwards, how it will happen? You will go to a bank, lock yourself to a forward price. Whatever the price prevailing on the day, you will be buying and selling at a locked price called as a forward rate, which you will enter into with a banker. This is how a normal currency trading will happen. Share trading options, share also will be bought like that only. But the problem is, for a share, there are 3 markets opened. 1, 2, 3. 3 options are open. Option 1, you can buy today and sell today. That's called as a cash market. That's called as what market, sir? Cash market. Terminology is important. Cash market is a place where you can buy and where you can sell for a transaction to be closed today itself. Means I will take my Demat account, I will open, I will directly go into the app, zero the app or whatever the case may be. I will directly click on buy money will be transferred from the wallet, contract over, purchase was made today, click also made today. That means I am not clicking today to purchase in future. Today transaction happened, sale also that way. These are called as a spot market, also called as a cash market. Cash market means what? Pay cash, buy, give, take cash and sell. This is how you will do. Cash will happen immediately. Cash means not physical cash here. I am not telling currency. I am telling cash. Cash means what? In terms of money, you have given, you have taken. Everything happened at spot. Those are called as a cash market. Clear, everyone? This is how normal stock normal stock markets will work. Okay. So there are two types of markets. There in the cash market there are only two types. Number one, there can be either a speculation. There can be only a speculation. What do you mean by speculation? Speculation means I will expect the TCS share will rise to 2000. Say for example, TCS share price. Say for example, it will reach somewhere around 3100. I will expect that in mind. I will buy a share today morning at 3050 rupees. Evening time, really my expectation has gone correct. It went to 3100. 50 rupees gain on each share. Or I sell. Okay, really the share price is only 3010. I made a loss. Okay, I may make a gain, I may make a loss. It is only a gambling, it is only like a betting, which I will assume something which may happen, may not happen. I will be called as a speculator here. Normal share market speculations will happen. Arbitration. Generally, chance of arbitration in the direct cash market may be very less, but chance is there. What does it mean? I want to invest in a share. I opened NSE website. Share price is shown at 2000. I opened BSC website. Okay, I opened BSC website and saw the share. The share price is trading at 1985. Means what? There is an imperfection in the trading in both the markets. Both are two different markets. Price need not be same. Small changes will come, but here there is a good change has come. Immediately I will buy my share through the NSE demat and I can sell in the BSC demat, or vice versa you can do to make a profit. So that's the concept of an arbitration. Rarely happen in share market, but chance is there. Share market you invested. Share market what sir? You invested. Okay. Once you invest, you will not have a peaceful sleep because of two reasons. You will buy today to sell in the future. You will buy today to sell in the future. Some people will make a short sale. Some people will make what's a short sale. What is a short sale? When they feel that the prices of shares are very high on a particular day, I want to sell on the day, but you don't have a share. What they will do? First, they will borrow the share and sell. How that happens in this chapter, again I will repeat, in the portfolio theories and asset pricing models, in the arbitrage pricing theory chapter topic, I clearly explain what is a short sale to you. But still, I will reiterate the same concept even here. I will reinforce, but not everything. Out of a motherly affection on this subject, I can repeat to some extent, but don't expect me to reinforce everything inside that particular concept of short sale. It takes a lot of time. I will explain the whereabouts, the concept of what is this idea behind the short sale. Short sale is a concept where I will sell a share without having a share. Okay, by borrowing it. To borrow means you have to give back or not. To give back, what you have to do? You have to buy and give back. So, whenever you take buy position in the cash market, listen to my words. Buy position in the cash market or sell position in the cash market. Okay, you have two risks. Risk number one, if you buy a share, risk is fall in prices. If you sell the share, short sell the share, risk is rise in prices, because I have to give back by buying the share in the future. So therefore, you will buy a share today to sell it after 6 months. After 6 months, can you guarantee a price? It may be high, it may be low. You will fall into speculator stage. I don't want to do that. I want to lock myself to a price today itself. So is there any concept like that? Then one person will come and stand out from you and he will tell, I am there to secure that. That concept is called as derivative options. That's how the options concept came. Means what? Derivative options is a concept where I will secure you from your forward market. Means what? In the forward market, I will first lock you to a price. Say for example, a share price of 3000. Price may be 3500 on the day. You will buy from me only at 3000. Another person will be there. He is called as a writer. He is called as what's a writer. This person says that I promise you to sell each share of TCS at 3000. Whatever may be the price of that share in the near future. 6 months now, I will sell you at 3025 rupees. So share price is going beyond that 3080. It's none of your business. I will sell to you only at 3025. Clear everyone? So therefore the logic we have to understand clearly. Writers are the... So if I buy a share in the cash market today with the intent to sell in the near future, say 3 months or 6 months, I have a risk of fall in prices. Yes, I have a risk of fall in prices. If I short sell today, I have to buy and return back. I have a risk of rise in prices. In both the cases, forward market or future is a turbulent for me. Anything can happen. I want to get a safe shield for that. That shield was created by a market called as options. Okay. An option is a situation where a person will come to you and say, I will buy from you if you sell in the near future. Okay, I will buy for you at a fixed price. Say 3000 rupees for each share. Or I will sell to you at 3000 for each share, whatever may be the price on that day. That means I am hedging and securing my position today itself. In cash market, you will make a buy and sell. But to secure that buy and sell, you need a hedging strategy. Options strategy is a hedging strategy. Derivative options means hedging. You already had one position in the cash market. I repeat, you already had one position in the cash market. You buy the share, risk is a fall in prices. You sold a share, risk is a hike in prices. In both the cases, you want to secure your position for the future. What is the chance that is available for you? Enter into options market such that they will lock you a future buying price or they will lock you a future selling price. So now today, have a clarity. Today you bought the share or sold the share in the real cash market. Bought the share. Now you have a risk of what? Fall in prices in the future when you try to sell. You have to sell in future. So therefore you will lock a selling price in the future today itself. Whatever may be the price on the day, you can sell the share at that particular pricing. But there is a small conceptual difference between normal forward and options, because there is only an option to buy and option to sell. It's not an obligation imposable. Okay, why like that? That all we will discuss in next stage of the discussion. Hope everyone understood the concept up to here. So share market, cash market, you can do only speculation and investment. Sometimes speculation, sometimes investment. Okay, some people will be there. They will invest in the share today, happily sleep. 3-4 years after, they will enjoy the gain. They will sell at a heavy market price. Those are called as investors. That's all. No speculation, no arbitration, no hedging. They don't even bother about hedging because fall in prices don't affect them because they are not trying to sell the share in the near future. So arbitration, they don't even care. Hedging, they don't want. Speculation, they don't do. So they are only investors, that's all. So we are not discussing about them. We are talking about those traders who want to sell and buy and make a obvious gain out of the transaction. For them, in the normal cash market, there will be buyers and sellers and investors will be there. But in a derivative segment, there are speculators, arbiters and hedgers. 3 kinds of persons will be there. Essentially, options concept is hedging. Essentially, options contract is hedging. You want to lock yourself, that itself is called as a hedging. Clear, everyone? So, in the normal cash market, you will make buy and sell transactions. In the options market also you will do buy and sell, but in a different way. How differently that will be done itself we are going to discuss in this chapter called as derivative options. So derivatives are used for 3 purposes: speculation, arbitration, hedging, not for investment. Options are not investment strategies. Those are speculative or arbitrage or hedging strategies. We will see arbitrage and options. We will see speculation in options. We will see hedging in options. Everything we will see. But highly chance is hedging. Highly chance is hedging. How it will be done also we will see. That's why if you see one of the latest problems, they used calculate the perfect hedge. Binomial model when they do, they will use the word calculate the perfect hedge. Because option is essentially a hedge instrument. Hedging means risk reduction strategy. Okay. Next, unlike the shares, derivatives are generally traded in lots. Means you can't buy one share or two shares in option. Bulkly you need to do anything. Unlike shares, derivatives is not meant for investment. It is for the above said three purposes only. Derivatives can also take the shape of money markets. Derivative need not be restricted only to shares. It can also go into banking market. So there, borrow and lending will happen, which is called as interest rate risk management and interest rate swaps. Okay, this is the first basic primitive way of understanding the derivative options. So before we go on to the next part, please have a small notes on this. Everyone write down this. So hope you completed writing. So the next part. See here, understanding the options market. Understanding the options market. Okay. See here. First point number 1. As I already introduced you to the basic concept of the options, I will make it much more clear through 1 or 2 examples. See here. In a currency forward market, there are two persons. Okay, there are two persons. Number 1, customer. Number 2, banker. Customer will go to the banker. First, we need to understand to what extent currency market and options market differ from each other. In case of currency market, there is a customer, there is a banker. Banker will buy and sell currencies. He is not a mediator in between two persons. There is a importer, there is a exporter. There is a importer, there is a exporter. Importer has to pay. Exporter has to receive. In this transaction, what they will pay? Importer will convert his home currency, make it into foreign currency and pay. Vice versa will happen. Exporter, importer category. So who is this converter in between? This is a banker. Reverse case scenario, if you take exporter, importer. Has to receive. Importer, in his home currency, he will pay. We have to convert into our home currency now. Okay, in his home currency he will pay. Means technically this is a foreign currency for exporter. We have to convert. This conversion is done by whom? Banker. If you observe this entire scenario, banker is not a mediator between two. Banker will be the converter. Means he will be the executor of the transaction. That's why they are called as a dealers. Bankers are never called as a brokers in forex market. They are not brokers between two persons. Importer is not buying foreign exchange from exporter. He is buying goods for the payment facilitation. I require foreign currency. From this, what you have to understand? In case of forex market, the position of a buyer is not same like a stock exchange in stock market. Stock market is a broker between two persons. It's a pass-through between two persons. But in case of a stock market, okay, stock market stands as a pass-through between two parties. A want to buy share, B want to sell share. How A will know about B, how B will know about A? That facilitation function as a broker will be done by the stock market. So simply the role of a stock market is as good as a role of a house broker. I want to sell my house. How public will know? I will appoint one house broker who is having contacts. That person will go to the market and tell, some Koushik Mukesh is there, he has a property, he want to sell that. If you want, I will arrange a negotiation, he will tell. He essentially acts as a broker. Stock market is a broker. I want to buy, I want to sell, I want to match buyers with the sellers. Here, banker's intention is not to match buyer with the seller, to buy currency and to sell currencies. So therefore, position of the buyer, position of the stock exchange, both are not same. So don't understand the situations and concepts inside derivatives from the point of view of currency market. Just we completed forex the full, each and every nuke and point we covered now. Don't put that in mind and listen to derivatives understanding that this is a continuation to that. No, that concept is completely different. This concept is completely different. Both are two different concepts in itself. There the banker is a facilitator. He will buy and sell. But here stock market will not buy and sell. You will buy to some seller. you will sell to some buyer. So therefore, try to understand here, essentially stock market is only a matching concept. Means what? Buyer will be matched to seller, seller will be matched to buyer. This is a work of a stock exchange. So therefore, in that regard only, we need to understand entire concept of options. I hope that everyone understood the concept of currencies and stocks. Both are two different concepts in itself, right? Now, currencies, there is a concept called as a forward market, dollar forward market, like that. In shares, forward market is not there. There are two types of market, futures and options. Futures and option. Future, name itself is telling it is in future only. It's not forward, it's a future. We will understand in depth about this in the next chapter called as a derivative futures. Now we have to stick our entire discussion to options concept only. So let us understand what is a option. Option is also a derivative, is also a security, but this security don't have value on its own. It derives value from the value of its underlying asset called as a share or a commodity. Let us understand the share options only first. Okay. Now listen carefully to the logic. So futures and options. Option is a derivative. Means it does not have any change on its own. It changes according to the change of its first variable called as a price change of the share. Share price changes, immediately option value also changes. On this we make a complete discussion in arbitrage concept. Remember my words clearly. When we come there to the arbitrage concept, I will explain very clearly in detail how this justification will be given. How this justification will be given that option don't have any value on its own. It derives the value from the value of its underlying asset. To understand that there is a concept in itself called as a arbitrage, also called as a theoretical boundaries to the option values. Very popular exam questions. There when we come, I will explain very much in detail. As of now, listen carefully. Option derives the value from the value of its underlying asset. As such, it does not have any value on its own. Hope up to here everyone understood. Okay, listen. I will give you one example. We went for an Odessa. A show. Okay, watch an Odessa. We went to a show. Say for example, we want to go for a particular movie, or we want to go for a audio release or a pre-release function. Ticket price is trading somewhere around 5,000, 6,000 for the front row. A big magnum opus is getting released. For that we need to be a spectator in the first or second row. Maybe a couple of rows only. We don't want to go far away. For that passes are getting released. Clear? Seating capacity, say for example, it is 1,000. Already celebrities and all the other have already booked it. Show is fully complete. House full 20 days back itself. But I want to go. Are you understanding? There is a black market that is running for the same. There is a black market that is running for the same. What that person said, sir, that movie pre-release function means India's prestigious movie, like RRR, like Bahubali or something. It's a prestigious movie event, sir. We have to watch it live. So people are literally dying to watch it on the first row or second row. They are spending 10,000 also on the ticket. Like that they will get. I am talking about pre-release function, not movie release. Okay, pre-release function, sir. All the star actors will be sitting on the stage, or they will be hosting the stage. So people want to see it live. So there is a huge demand for the pass. Like that they said. I want to book a pass for that particular pre-release function. For that event I want to attend. Okay, one of my friend is working in that particular digital marketing media. Examples, all are examples. I asked him, write a pass in my favor here. I have done so many audits for free of cost chartered accountant does na. So I have done so many things to from our childhood. So do this favor. You are in that media operations na. So please give me one pass. I don't bring entire family. Only I will attend. But on the first or second row, I need to see the stars on the stage directly. So please, along with the media, I want to stand. So plan like that. Please do this favor, I asked. He said, okay, I will write a pass. Tickets are over, but I will write a pass such that one chair will be arranged for you. You can sit there. I will write a pass. You needn't even pay the money. I will arrange everything, he said. Are you understand the point now? Now he has written a pass to me. This paper is having a value or no value. If I really have to sell this will have a value or not? Yes. This piece of paper derives its value not because it is a paper, because it is having underlying asset called as a pre-release function. How good that pre-release function, how hyped that pre-release function, how celebrated that pre-release function, that much value this paper will have. Are you understanding or not? If it is a next SS Rajamouli's next movie, okay, pre-release function, it will have a bumper value. If it is a normal star or even not a star hero, pre-release function is going on, that doesn't have any value, even attendees will not be there. So how this paper will work now depends on what show is underlying that particular document. Okay, say it is a RRR pre-release or Bahubali 1-2 pre-release or KGF chapter pre-release. So it will be having a huge hype throughout India. On that I have a pass, I can see Prabhas, I can see NTR, I can see Ramcharan directly from the stage. So very near. Means how that will be, how that look like. Are you understanding or not? So you should now imagine, people will be crazy about them. They are crazy to see them in such a scenario. What will happen automatically? That will have a huge value. So 20 days before, my friend wrote me a pass. I went to outside the hall, or I went to the market and I said, I have a pre-release function pass. 2 persons can attend on this. I asked for only one. My friend has given 2 entry pass. So I am going, I said. One person said, I will give you 2,500 rupees. Please give it to me. Anyway, ticket take 2,000. I will give you 2,500, he said. Hype for the movie release increased. Price of the option paper has increased. Are you understanding or not? Next. Show neared more. Means 15 days gap is there. One person say, I will give 3,000 rupees. Please give it to me. Another person, 10 days complete. Only 10 days gap is there. And I will pay 3,200 rupees. So final price, they are ready to pay. I will give you 700 extra. Please give it to me. Another person came and said, 5 days gap is only there. Flat 4,000 I will pay you. I want to see. I am a die-hard fan of Ramcharan. So therefore, I want to see him from the beginning. Really, I don't know that you have this paper. Please, I will give you 5,000. 5,000 or 4,000 flat. Please, book for me. Give that ticket to me. Give that pass to me. That pass is a bare instrument. Whoever have that person can go with 2 persons. Give it to me, please. 1 day only gap. Another person says, I am not a fan of any person. I am a fan to this movie. I want to see all of them from the front row itself. Flat 5,000. Give it to me. 1 day before. I gave that pass of 5,000 to the party. A paper which have 2,000 value at the counter has become 2,500 20 days before, 3,000 15 days before, 3,500 or 4,000 10 days before, 4,500 for 2-3 days before, 5,000 rupees 1 day before. Why this paper has a value here? Why this paper have a value? Because it derives the value from the underlying asset called as RRR. That has a value. That value reflects on the option sheets. Now listen carefully. Show started, pre-release function started, pre-release function over. We met everyone, we saw everyone from the front row, everything over. I came out with the same option pass paper. I asked, anyone want to buy? I will give it 2,500. They will not purchase even for 2.5 rupee. Why? You are ready to give 2,500. Expiry date has come. Already contract expired. Show a completed. From where the value you will get? That means per se this paper don't have any value. The value of this paper is derived from the value of its underlying asset called as audio release or pre-release, whatever you call. Hope you can understand what I said now. Same analogy works also for the stocks. How beautiful the company stock is, that much better the options will be. Fall of share will automatically lead to the fall of options. Same also with the futures. Okay. So what is the difference between a normal currency forward and options forward? Option currency forward with a banker, almost same. I want to buy dollar in future, but I don't know how the price will be. I want to buy a share in future. I don't know how the price will be. I don't know how the price of dollar in future. I will go to the bank and lock myself to a price. I will go to the options market and lock the price myself at a particular price. Currency la, whatever may be the price on the day for a dollar, I will pay only 80. Whatever may be the price of the share on that, I will pay you 80 is wrong. Currency is like, is true, but in case of options market, the person only have a option. On the expiry date, when he went into the market, price in the market is lower than the locked price, then lapse this and buy in the market. Means options la two parties will be there na, party 1, party 2. Party 1 says I will sell, party 2 sells I will buy. This buying is only an option for him, it's not an obligation like forward. Means what? On that day I said I will buy at 3000. On that day real market price trading is, take two situations. Market share is available at 3500. I have an option to buy it. At 3000. Now tell me, I will buy in the market. I will buy with the party 2. Party 2 because he promised, party 1 because he promised to sell only at 3000 a stock which is worth 3500. Simply to tell, a dollar is 80, real value on the day is 85 or 75. Now what you will do? You locked yourself at 80, but dollar rate on that day went to 85. You will pay 85 or 80, 80. But dollar rate fall to 75, then also you will pay how much? 80. There is a risk here. But in this particular area, such a risk will not be there. Why? Price is trading at 3000. We locked it at 3000, but real price may not be the locked price. So it is 3500. Means what? It is higher than what I locked myself. Now in this case, you can exercise this option, you can buy only at 3000. But conversely, in the contrast, price of the share has become 2500 only. That means if you say yes to the contract, you have to buy at 3000. But here you have an option to say, buy only at 2500. You can lapse this option, you can buy here. That's what we call as an option. Option, what is the beauty of option? When if the market is favorable to you, cancel the options and go and buy. If the market is unfavorable to you, go to the party 1 or 2, whatever the case may be, and exercise your contract. Clear? Sir, here party 1 promised that he will sell. That means he will have an option to sell. No. Seller will have obligation. Option to both the parties means if it is favorable to P1, it is always unfavorable to P2. Vice versa, then they will not execute the contract. So it should be option only to one person. It is an obligation to the another person. Okay. On these all these points we will discuss once for all at a later stage. Hope everyone at least understood the basics as to what I want to convey. Options market is similar to the currency forward only. However, currency forward la obligation will be there. Options la obligation will not there. It is only an option. Since I am calling it option, it is not option to both the parties. It is option only to one of the party. To another party, it is an obligation also. Clear or not, everyone? So this is the whole idea what I want to discuss with regard to the options. In pure terms, an option is a privilege which is sold by one party and bought by another. It is an obligation to one party and option to another. Options can work on anything, namely, it can be stock options, it can be currency options, it can be interest options, or it can be commodities as well. There are two types of options mainly, call option, put option. Meaning everything we will understand later. First, write down these particular notes. So hope everyone completed writing the notes. Next. Concept of options and parties. Share market la buyer seller. Forward market in banks la banker customer. Okay. But who are the parties inside the options? First we need to have a clarity. If it is a call option, this is the diagram which helps you. You should read from left to right, means Mr. A to Mr. B. Okay. Observation required. Okay. See here. Mr. A promised to sell Mr. B. Mr. A promised to sell Mr. B. What you promised to sell? 1000 shares of TCS on 31/8/2022 at rupees 3,000 each. Repeat. A made a promise to B that he will sell 1000 shares of TCS on 31/8/2022 at 3,000 rupees per share, irrespective of what is the real price of the share at the future date. Today is, say for example, 1st March. I am closing the contract on 31/8 itself. April, May, June, July, August, 5 months before. March, April, May, June, July, August, 6 months. 6 months before, I am locking myself at 3,000 price. I want to buy. Some persons promise that I will sell you at 3,000. Now in the real banking market, how it will be, whether it may be 3,500, whether it may be 2,500, you have to buy at 3,000. But it's not like that. It is only option even now. How? Let's see. Mr. A promised to sell to Mr. B at how much? 3,000. Now from right to left you see. B has an option to buy. You are selling now, I have an option to buy on the due date if the market is unfavorable. Means what? B has to buy. Buying is optional, buying is inevitable. I can't stop buying. But from whom to buy is a question now. I have to buy from the open market or I have to buy from Mr. A is a point of discussion. Means I have to buy, there is no other option. I already made a short sell in the short sell on 1st March. I have made a short sell on 1st March when the prices are raised. Now anyway I have to close that short position by buying and selling, giving back the shares to them. Buying is inevitable. B has to buy. But from whom to buy is a query now. Okay. So P has an option to buy on the due date if the market is unfavorable. If the market is what's unfavorable. Means how to understand this? In the market, the price of the share on 31/8 went to 4,000. Then if I have to buy in the open market, I have to spend 4,000. But Mr. A already promised me that he will sell at 3,000. I will exercise that and I will ask Mr. A, please give me at 3,000. What happens to writer? What happens to Mr. A? So loss again, that all leave off. First understand from the B point of view. B will buy the share from Mr. A by paying 3,000 because market is unfavorable. Market la price came to 2,500. Now, like a currency market, I need not do all these things here. What I will do? I will tell, sorry Mr. A, in the market it is available at 2,500 only. So I will not buy from you. I will buy from the open market at 2,500. I will lapse and I will buy. LAPSE, lapse. Lapse means to relinquish, to leave. I will leave this option. I will go to the market and I will purchase only at 2,500. That means in the option contract, the person who is having an option will not make a loss. Will not make what, sir? Loss. They will not make a loss. If loss is coming, they will lapse and they will buy in the market. Okay. So this is how we need to understand. So here the terminology is important. A A is the person who is promising you to sell na? That person is called as a writer. That person is called as a writer. He will sell you the option. He will sell you the option. This meaning you can't understand unless and until I show you this example. As of now, understand, he is a writer. He is a writer. Sorry. Writer. He has an obligation, not option. Option to whom? Option to B. Sorry, both the persons are having option. When it is a option exercised by B, he will tell, I don't exercise my option to sell. I will not sell to you. So therefore, it is option only to one party, obligation to another. Next, B is called as a holder. What holding? You are holding an option. You are writing an option here. You are a holder of an option. He is a writer of an option. He will be having an option to buy. This is called as call option. This is called as what option, sir? Call option. How that name has come? See here. I want to buy the shares in future. I want to buy the shares in future. I want delivery. I will make delivery. I want delivery. I will make delivery. What I will do? I need delivery. I make delivery. Call option means I have to buy the share. I have to buy the share. So I will deliver shares. I want shares. I want shares. So call him and tell I want. So that's called as a call. Put option means reverse. I want to sell the shares. Put the shares. Deliver the shares. That's how the name called as a put there. So call option means calling to buy, calling for a delivery. Put option means making the delivery. Put there. Okay, put there. Put what? Put shares there. So I want to sell the shares. So see here the terminology. A who promised to sell is a writer having an obligation. He is a holder having a option. Next, 1000 is a number of shares. Lots will be there na. 1000 shares. One lot is 100 shares na. There will be 10 lots. 1000 shares. On 31/8/2022, it's called as an expiry date. It's called a what date, sir? Expiry date. Okay, maturity date. Shares of TCS is the underlying asset. It's RRR for us now. 3000 is called as an exercise price. That means if you want, you can exercise the option and buy at that price. This is called as exercise price, also called as a strike price. STRIKE, strike. So how this strike price works also I will tell. Okay. So this is a point. Exercise price, also called as a strike price. I repeat, A, writer, B, holder. A, obligation, B, option. 1000 number of shares, lots. Okay, 3000 each share price. Okay, share of TCS is underlying asset. 31/8 is the expiry date. Am I clear or not? This is the call option full chart. Same reverse will happen in case of a put option. Let us see the put option now. So the next one is a put option. See here, same thing, everything is same, with small mild differences. Okay, so what are those? Let us try to understand. Same, Mr. A is there, B is there, everything is same. A reverse. In the previous case, Mr. A promised to sell. Here the arrow mark changed. Promised to buy. That means B is having an option to sell. He has an option to sell if the market is unfavorable. Means what? I will lock myself at 3000 even here. If the price in the market now raises to 3500, I will tell him I have a chance to sell at 3500. So I will sell there. I will not sell to you. You need not buy. If the market price is 2500, what I will do now? I will tell if they sell in the market, I can sell only at 2500. But you said that you will buy at 3000. You buy now at 3000, I will sell to you. Okay, he will sell, that person will buy. Here I have a protection from fall in prices. Here I have a protection to the rise in prices. Okay, here protection again as the fall in prices. Here protection again as the rise in prices. Okay, so call option and put option works like this. Okay, one person only have obligation, another person will have a beautiful option. Okay, he don't have any obligation. Parties involved in their activities, I will discuss it later. once we complete this part of writing. So you write this put option, you just have to interchange this, just converse to the same concept is a put option area. First copy down this. So hope everyone completed writing the notes. Now we completed call option and put option as a concept. Generally, when it comes to the derivatives, while understanding at a basic level, okay, but while solving the problems, a lot of doubts will come. Why he is giving answer like this? Why he is giving a question in this way? In this question, how answer came like this? Doubts will come because how ask and bid quotations are very, very important in Forex to understand. Same importance is given also for, okay, same equal importance is with regard to the concept called as a parties involved in their activities. Which party will do what is the point we need to understand. Okay, see here. First thing is, options being call option or put option being an option contract is a typical insurance contract. It is a typical insurance contract. What does it mean? Insurance contract, there are two persons. One person is called as an insurer. Another person will be called as